Welcome to Trading Express. In this video, I am going to share the 5 key principles to be a successful trader. Then, we will apply these 5 key principles to an actual example. And then we will look at trades and reanalyze them to improve the trading strategy. There are many important principles in trading, but today I will show you the 5 that I believe are important to know. Key principle number 1. I call this the testing phase. First, you pick a trading strategy that you feel comfortable with. Next, you backtest the trading strategy at least 100 times. Determine the time frame, reward to risk ratio, asset, and with that, you will be able to determine the win rate of your trading strategy. It is very important to test your trading strategy because you need to know if your strategy is even profitable or not based on previous data. Now, there are a few ways to backtest your trading strategy. You can manually backtest your strategy. But that will take you a lot of time and not everyone has time to waste. Or you can use a script to backtest your trading strategy for you, with just a click of a button. Now, if you want access to one of our trading strategy scripts, you can have instant access to many different strategy scripts on our website at tradingexpressco.com. With these scripts, you can download it, and copy and paste the script into the Pine script section of TradingView, and it will backtest hundreds of trades within minutes. In this video, I will use one of my favorite trading strategies and show you how easily we are able to backtest many trades. If you are enjoying this video, hit that like button and subscribe for more content. Key principle number 2. Be persistent, or in other words, stick to your trading strategy. If one criteria for your trading strategy is not met, then do not take the trade. Lay out all the points and make sure that all criteria are met before taking the trade. Stay persistent and do not deviate from your trading strategy, especially if you have tested it in the testing phase and know it has a good win rate. Key principle number 3. Risk management. And this is by far the most important principle that I will talk about today. It is important for every trader to apply proper risk management for every trade. A trader should know what their potential loss or gain is before entering the trade. You can do this by: first, you never want to risk more than 2% of your initial capital size on a single trade. Second, always set a stop loss. Third, calculate your position size. Let us look at an example of why risk management is so important for a trader's success. Let's look at Guy 1, who has an initial capital of $10,000, and he buys a stock at $25 each. Guy 1 uses all of his $10,000 to buy this stock, so he buys a total of 400 shares. Suddenly the stock falls from $25 to $20 and Guy 1 loses $2,000 on his first trade. Guy 1 repeats this process for a total of 10 trades, which causes him to go from $10,000 to start with all the way down to just over $1,000. Guy 1 clearly used poor risk management and did not properly calculate his position size, which caused him to basically lose his entire account. Now let's look at Guy 2, who also has an initial capital size of $10,000 and also buys the same stock at $25 per share. However, Guy 2 decides to set a stop loss at $20, and he decides to only risk 2% per trade. Guy 2 calculates his position size by taking the risk per trade divided by the potential loss per share, which is $5. Therefore, Guy 2 will be buying 40 shares to limit his potential loss to $200. Now, the stock falls in value and Guy 2 loses $200, and if he had 10 losses in a row, he would still have $8,000 remaining in his account. Therefore, after 10 losses, Guy 2 only lost 20% of his initial capital, versus Guy 1, who lost nearly 90% of his capital after 10 trades. This is the importance of using risk management. Key principle number 4. Control your emotions. This may not seem like an important principle to have, but it is one of the key principles for a trader's success. If things are not going your way, make sure you stick with your trading strategy. Avoid panic selling at all costs. Also, if candles are approaching your stop loss, do not change your stop loss if you are afraid to take the loss. It will only cause you to lose more money in the long run. In trading, take profits when necessary and do not be greedy. Lastly, avoid FOMO, fear of missing out, because this will cause you to jump into a trade too late and cause you to lose money. There will always be trades available. Remain patient and stick to your trading strategy by effectively controlling your emotions. The last key principle that we will discuss is the reanalyze phase. Reanalyzing your trades is an effective method to learn from your mistakes and improve your trading strategy. After you have completed at least 100 trades, you should analyze each loss and determine the potential causes to that loss. The loss can occur due to FOMO, not being persistent with your trading strategy, not using proper risk management, or even changing the stop loss since the emotions got the better of you. There are many things you can do to improve your trades after analyzing them. A trader should keep record of all their trades and make notes as to what went wrong. Thus, after you have collected enough data with your trades, be sure to reanalyze them to improve your overall success. Now, we will apply these 5 key principles using a real trading strategy. This is one of my favorite trading strategies. It is the RSI, hidden divergence, stochastic strategy. The rules are very simple. You first need to identify a hidden divergence. A bullish hidden divergence is when candles are making higher lows, while the RSI indicator is making lower lows. A bearish hidden divergence is when candles are making lower highs, while the RSI indicator is making higher highs. We take a long signal when candles make a bullish hidden divergence, and candles must be above the 200 period EMA. And we enter on the next cross up on the stochastic. For a short signal, we wait for a bearish hidden divergence, candles must be below 200 EMA, and we enter on the next cross down on the stochastic. Now, that we picked a trading strategy, we must apply key principle number 1, and test this trading strategy to ensure it has a good win rate. To test it, we will be using a script that will automatically backtest for us, based on the criteria we select to take a long and short signal. Personally, manually backtesting takes a lot of time, and I do not have time to do that, so if you are like me and want to quickly backtest hundreds of trades within minutes, you can find our strategy scripts on our website at www.tradingexpressco.com. Once you have access to one of our scripts, copy and paste it into the bind script section of TradingView, which can be found on the bottom of the page. Then, click Add to Chart. Then, this icon will appear and you can click on the settings icon to change the variables. In this script, you can change it so that it only takes long signals, only takes short signals, or both. Furthermore, you can adjust the date range, the reward to risk ratio, the amount that you want to risk per trade, and the initial capital size. In this case, we will be testing Ethereum on the 15-minute time frame. We will be using a 1.35 reward to risk ratio and we will be risking 2% per trade. After inputting all the variables, click OK. And this customized dashboard will appear. The dashboard will instantly backtest all the trades available within the time period. The dashboard will display the win rate, the number of trades it found, the time it took to find those trades, the highest winning streak, highest losing streak, and net profit. In addition, it will scale everything to 100 trades, so that you can compare other assets with each other. Now, after backtesting Ethereum with this strategy, we found that we have a 54% win rate after 109 trades. It took 6.83 months to find those trades. And we can expect to have a net profit gain of 59%. Therefore, this is a profitable trading strategy and we applied key principle number 1 to confirm it. Now, let's apply key principles number 2, which is to stay persistent and stick to the trading strategy. Let's look at the script and see if it took an accurate trade. As you can see here, the script took a long signal, because the candles are above the 200 EMA, and there is a bullish hidden divergence. So it entered on the next cross up for a long position. Thus, for the second principle, you must only take the trades when all the criterias are met, otherwise, do not enter the trade and do not modify the trading strategy until you have enough data to prove otherwise. To apply key principle number 3, risk management. We must properly calculate our position size. To calculate your position size, you must know your buy price and your stop loss. Once you have that, you can input it into this spreadsheet, which I will leave in the description below. The spreadsheet will calculate your position size, based on the input variables. Since we inputted an initial capital of $1,000 and are risking 2% per trade, the position size will only be 0.15 Ethereum. Therefore, if we were to lose a trade, we would only lose $20. This is how you apply proper risk management. Next, apply key principle number 4, by controlling your emotions. Like I mentioned before, if things go south and you start losing multiple trades in a row, be persistent with your trading strategy, do not deviate from the strategy. Also, do not change stop loss just because you see yourself almost losing a trade. This will hurt you in the long run. Thus, control your emotions. Lastly, let's apply key principle number 5. Reanalyze. This is an important key principle and it is what a trader should do every so often to reanalyze their trades. Always keep a clean record of all your trades, look at your losing trades and determine the potential causes for those losses. You can make a note to what caused your loss, whether that is FOMO, not being persistent, not applying proper risk management. Or it could even be a lack of not using price action with your indicator trading strategy. And there you have it, that is how you apply the 5 key principles in your trading strategy. If you enjoyed the video, leave a like, it will help the channel out, subscribe to our channel for more content.